Hello traders, Gary Wagner here, approximately 10:30 in Honolulu, making it 4:30 in New York. It is Wednesday, the last day of October 31st, 2012, and this is the daily report for gold and silver. Nice, strong showing across the board in the precious metals markets. As you can see, we're currently looking at our weekly chart of gold, up approximately $12 to $13 higher, 1721.43. That's your bid. 1722.42. That would be your ask. As I said, putting it up about 12.40 on the day. 1710 on the low side, 27 on the high side. Silver also showing a very strong, resilient market move today. It's actually up almost 2%, 1.25%, 1.7% higher. Low today, 31.73, high 32.54. As you can see, up about 50 to 55 cents higher, 32.30, 32.29. And as I said, that puts it up about 55 cents on the day. I want to start out today's show by looking at a short-term gold chart, and then we'll move consecutively outer into more compressed time sequences. We're looking at a 360-minute. It is in straight candlestick format. We talked about a couple of things over the last few weeks. First thing that we talked about in terms of a straight psychological level, 1700 is a very important point that I felt it really had to hold here. 1700 right on the mark. This is actually just below, this being about 1699. As you can see, this market did in fact hold that support level, has begun to move higher, and as I said, currently trading around 1721.30, putting it up about $12 on the day. Now, we have hit a very interim resistance point, and that being 1721. In terms of the areas that we need to watch, we'll talk about that on today's daily report. Traders, as you can see, all I've done is converted our short-term 360 candlestick chart into a Heikin Ashi chart. And really what it has shown us on today's trading, let's go ahead and blow that up just a little bit more so I can give you a better idea of what I'm looking at. Over the last couple of days, what we've really been talking about is that for the first time in a while, we are getting these alternating candle colors. You can see as I highlight it, you can really see how they alternate even a little bit better. You get a series of red, then a series of green, back to red, green, red, green. Now, we got this very small doji, and we've had a couple of them, so that's really not what was the greatest indication, but you had a very small doji right in here. But look what happens right after that point. The next three candles have lost their lower wick. They've all gone green, and they all have maintained lower or higher lows each time and higher highs each time, moving to the upside. Oddly enough, you can see that right now it's stalled just a little bit. And as I said, that is a pretty important but a interim resistance area in terms of a Fibonacci. It's a 50%, and it is a 50% of a longer Fibonacci sequence. Let's go ahead and compress that so you can really see where we're drawing it from. And as I said, you can see that this particular 50% retracement right in here is the smaller of the two retracements, and it is, let's move that there, and it is simply looking at this area and then saying, okay, a 50% retracement would take us right to here, and you can see that's where the market is on a tentative basis. Now, my sense is that that shouldn't be that difficult to overcome. The key point is going to be right in here, 1747 to 1753. It's a key area, and I'll talk to you about why I believe that is in a second. And this is why I consider the 1750-53 area to be pretty critical in terms of how our count is going and really what we're looking at in the market. So bear with me for a second here, traders. If in fact the count that we're looking at is correct, and the way that we want to look at it is in terms of our major count, of course, we go, this is our fourth, wherever that ends, that's the tricky part on this particular chart. But we definitely go into our intermediate wave 1. That wave 1 can probably be broken up into 1, 2, 3, 4, and then 5. Something like that. Now, that would give us this wave here being an intermediate wave 2. Now, our intermediate wave 2 should have a subcount behind it, probably, most likely, of an A, a B, and a C. That being said, it seems fairly logical at this point to look at this as our A, and the possibility does exist that we are currently in that counter wave, which is our B wave. And that's why this area is so important, because if in fact it's going to follow straight Elliott wave, there is a likelihood that somewhere between 50% of this move down and 75%, which puts us between 1748 and 1774, this market could in fact stall right here on this counter wave, and then we would have a final push down. That push down would be a C wave. That C wave could either be a flat, which would take us back to 1700, or it could be what's called a standard zigzag, which would take us lower. I put it at about 1631. That would be the low. I don't really think it's going to go there, and I am anticipating more or less a flat, but realize, traders, I'm a market bull, so I always look at, when I look at scenarios, as the most bullish of the plausible one, unless the technical evidence supports something different, if it's just a model. And if that's the case, and if it would pan out that way, that would conclude our secondary, our wave 2. So we would have 1, 2, and then we would go into our third impulse wave. That's one particular model that we want to consider and look at. The other model is one that we began to discuss yesterday, and that's the fact that what we could really be seeing here in terms of a Western pattern is a cup and then a handle, which is right here. Once we get the handle to come up here, as you can see now, it's handle-esque, so to speak. You have your cup and your handle. This is considered your breakout point right in here, and so you want to see how it reacts there. That's another model, a technical model that's based upon pattern recognition. Now, the best way for us to proceed is with our long positions. We want to be very careful once the market gets to about 1748, 1750. If we see the market pulling back, we're going to want to exit that trade, even though it's only got a little bit of profits. See where 2 wants to take us, and then look to re-enter from the long side, because we really want to position ourselves strongly for this impulse third wave. It's going to be a whopper, and I can tell you this, for it to be a valid wave, first of all, it really has to start to take out these tops. These tops have been threatened, but they haven't been taken out. You've got a double top, 1 here, 2 here, and of course, this being the third, now that it's come down, it's going to have to take that out. And that's absolutely essential for us to maintain the bullish stance that we are maintaining. But traders, at least for now, I'm very, very pleased with what I am seeing within the market. Let's go back to this weekly. You know who we've been looking at this with some detail. I want to keep this one simple without any kind of Elliott wave and other studies, because what I really want to focus in on this chart more than anything else is Fibonacci retracement levels in terms of how they work with straight candlestick patterns. And so what we're seeing and what we talked about, you know, we've talked about this for the last week. First, it was my belief, my assumption that we should find support at 1700. We in fact have. I also talked about the fact that as this marketplace came down, this last candle is really becoming doji-esque. In other words, it's a very, very small body compared to these. Your low held above or right around, call it 1700. And as you can see, this candle has absolutely gone green. Depending on where it closes, we could get a nice strong green candle. It is already an engulfing bullish, just as this is an engulfing bearish. And then once again, traders, what would we look for in an engulfing bullish? Well, we would look for confirming candle. Confirming candle would be the following week. You get a green candle with a higher high and a higher low. Silver. doing very well today. And as you know, the one thing that we can always count on with silver is that we're going to tend to get steeper moves both to the upside as well as the downside. And that's the case today. You've got as I said, almost a 1 3/4% advance, being up about 50 cents on the day. 240-minute chart. You can see we held this really, really solid level of support. My belief was this was a critical level. Our stops were just below this, but 31.47. You can see it kind of wavered, and just as in gold, we have had a scenario. Let's go ahead and kind of make this simple to look at. We've had a scenario of red, green, red, green, red, green, red, green, that alternating. Now we are back up to our resistance area, because realize, just as in gold, we identified a significant sideways trading range. We really need to see the market trade above 30, call it 32.50. It's 32.41 on this chart. But that is, to me, will signal a move back to the upside, and then we can look to see where our different areas of resistance should be. Right now, 33.25 and 33.57. This has been Gary Wagner, wishing you, as always, good trading. Talk to you tomorrow for another daily update and review. Bye-bye.